Hey everyone, over the past year, we have all experienced something that we never would have expected before. An unprecedented shutdown in many industries caused by a fast-moving and widespread virus, and one of those industries that was most significantly impacted was the travel industry, from every segment including airlines, airline manufacturers, to travel agents for corporate and leisure travel, and many other segments. So it's no surprise that one of the most common questions I've been asked this year is whether you should be investing in travel stocks in 2020, but also in 2021 moving into the next year as this pandemic seems to be reaching an end point. So in today's video, I want to share with you 3 reasons why it may be a good idea to invest in travel stocks, but I'm also going to share 3 reasons why it may be a good idea to avoid a particular travel business, essentially giving you 6 important characteristics or attributes of travel businesses, 3 that you want to see in every stock you invest in, and 3 that you want to avoid in businesses you invest in, eventually giving you a checklist of 6 important characteristics or principles that you should go through before you invest in a travel business or for any business for that matter. I'm also going to share some examples of travel stocks that meet the good attributes and also have the bad attributes throughout this video so that you can see how I'm applying these things to real businesses that you may very well be looking to invest in. Oh, and if you're listening to this and hearing my Australian accent and wondering whether this only applies to Australian businesses, it doesn't. It applies to businesses on any stock market, whether that's the US market, the ASX, the Australian market, the UK market, or any other market globally. The first reason why I think it's a good idea to look at businesses in the travel and tourism segment is because the travel segment is what I would consider an evergreen industry. According to Statista, the global travel and tourism industry contributed $9.3 trillion to the global GDP. And while the travel and tourism industry does decline during weak economic conditions, such as in 2009, over time it does grow and has consistently remained one of the largest contributors to global spending. I consider the travel industry an evergreen industry because, broadly speaking, travel has and will always remain very, very relevant, and it will grow over time as productivity increases broadly. So what I mean by that is over time, as businesses produce more and as people's wealth on average rises, people will be willing to spend more money on travel. More people who could not afford to travel will be able to travel in the future, and businesses will require more corporate travel. Of course, like any industry, there are pockets of the travel industry that are going through significant changes. One of those key examples is what's happening in the travel agency space, as we have these new online travel agencies that are taking significant market share away from traditional retailers. Physical travel agencies are becoming less relevant as OTAs like Expedia or Booking Holdings have become more popular. And while corporate travel, of course, will grow consistently over time, it may grow at a slower rate on average because of things like the internet that allow conferencing online and reduce the need for expensive corporate travel that was necessary many years ago. The second reason why investing in travel stocks at the moment is a good idea is because the industry, broadly speaking, is going through what I would call a short-term problem. A short-term problem is when an industry is broadly suffering from lower revenues and or lower profits due to a problem that has a definitive endpoint in 12 to 24 months. Short-term problems are ideal for retail investors like you and me, the small guys, because often share prices go down during these periods, and it allows us to invest in really great companies at far lower prices. The reason why stock prices go down, even though this is a short-term problem with a definitive end, is because big fund managers and other institutional investors who control most of the money flowing in and out of the market are often unable to hold on to investments that are expected to decline over the next 12 months. The short-term problem that the travel industry is facing right now is, of course, the pandemic that we saw over 2020 and is likely to continue for many more months into 2021 and maybe even to the beginning of 2022. Travel companies are being impacted by travel restrictions as well as a general reduction in consumer spending. Lots of people have insecure work at the moment and are therefore cutting excess and unnecessary spending, which often includes travel and tourism. And this short-term problem does have a pretty clear endpoint. While we don't know exactly when a vaccine will be widely distributed, whether that's at the end of 2021 or halfway through or at the end of 2022, With multiple vaccines at the end stage of their trials and just beginning production in the next few months, it's very, very likely that this pandemic will be over and that the restrictions will be broadly lifted for travel businesses within the next 12 to 24 months. The third reason why it may be a good idea to look at travel stocks as investments in 2021 is because a lot of them are in segments of the travel industry that are high barrier to entry, and that makes it really easy for existing businesses to continue to thrive over the long term. Aircraft manufacturers like Boeing, for example, require extremely large amounts of capital just to operate, and even when they're handling and producing half of the world's requirement for aircrafts, they still have very, very low profit margins. And while this sounds like a bad thing to have really low profit margins, it also means that it is impossible or near impossible for smaller manufacturers to compete at any extent, because even when you're at the size of an Airbus or a Boeing, you're barely profitable, which means if you're any smaller than that, you are not going to be making any money, and it makes it very, very hard to compete over the long term. Whenever we invest in a stock, we need to make sure that the business has at least one distinct competitive advantage that is going to allow it to thrive over the long term, and that just makes the business more certain, the future of the business, and therefore makes the future of our investment much more certain than businesses that don't have any advantages. High barrier to entry is probably one of the most common advantages that some businesses have in the travel segment, but really the principle here is that the business just needs to have some kind of competitive advantage, whether that's high barrier to entry or whether it's something else that the business does that is unique that customers can only access by going to that business directly. So that's 3 reasons why it might be a good idea to look at some travel businesses in the travel segment. But now I want to flip that on its head and talk about 3 reasons why it might be a bad idea to invest in travel stocks in 2021. And the first reason is that a lot of travel stocks carry a significant amount of long-term debt. As we've spoken about through this video already, many businesses in the travel segment require a huge amount of money to operate on an ongoing basis and then also to expand. And as a result, a lot of travel companies end up taking on a significant amount of debt just to compete with the other businesses. Boeing, for example, has almost $20 billion in debt, and this has consistently gone up over time. Most recently, you may have heard of all 4 major airlines in the US requiring a government bailout because they could not pay their debts while there were travel restrictions early in the pandemic. And while some of that bailout was partly due to really poor management of money within those businesses, a significant amount of it was attributable to the fact that during the travel restrictions, they were losing money and they had significant debts that were due at the same time, and the combination of those meant that the businesses would not be able to operate in the future without getting some kind of outside money. And if it still isn't obvious to you that avoiding high debt companies is probably a good idea, just look to what happened to Virgin Australia on the ASX. The company started to lose a significant amount of money every single week while travel was restricted in Australia and they had significant debts that needed to be paid. They went into voluntary administration in April, and the company was sold for pennies on the dollar to Bain Capital, an American company. And since people that Virgin owed money to get paid first before shareholders were completely wiped out during this process. A quick check that you can do to make sure the company doesn't have too much debt is to look at 2 ratios. One is the current ratio and the other is the debt to equity ratio. For the current ratio, we want this to ideally be above 2, but be above 1 at the very least. And for debt to equity, we want it to be below 0.5 in ideal conditions, but at the most be 1. My free stock analysis spreadsheet does this calculation for you, so if you want to download a copy, you can via the link in the description below. And there is also a full video guide on my channel to help you fill it out in just a few minutes. The second reason why you may want to avoid travel businesses in the travel sector in 2021 is because a lot of businesses in the travel sector at the moment are currently losing money. When a recession or some other kind of short-term problem hits an industry, some businesses will go from being very profitable to less profitable, but still profitable, while other businesses that have high amounts of fixed expenses will go into a loss. They will have more expenses than the money that is coming in, and as a result are burning cash, are losing money until the problem is fixed. This is the case at the moment with many high capital intensive travel businesses like airlines and some types of travel agencies. American Airlines, for example, made a $1.7 billion profit in 2019. That changed to a $6.3 billion loss over the past 12 months due to the pandemic. Australian travel agency Flight Centre was burning $40 million a month during the height of the pandemic, and that was even after they already stood down 14,000 of their 20,000 staff and shut half of their global locations. So even after cutting 2/3 of their staff, they were still burning $40 million a month. You should avoid businesses that are burning money, because even though the pandemic is a short-term problem and these businesses on average will return to profitability over the long term, in the short term, if they are losing money week after week, month after month, it is very, very challenging to calculate the damage that will be done during the short-term problem. And all of that damage will, of course, be impacting shareholders even after the pandemic is finished. Flight Centre, for example, was forced to raise equity by selling more shares in the market. So essentially, the management team ran out of money. They couldn't take on any more debt. So what they do is they create new shares, which increases the number of shares outstanding and sells them to the public. And when they did this in April of this year, they ended up doubling the number of shares outstanding. So an easy way to explain this is, imagine that you had one piece out of an 8-piece pizza before the pandemic hit. Then after the pandemic, the management team needs to raise capital, needs to sell more pieces of pizza. So what happens at the end is you have one piece of pizza out of 16. The number of pieces has doubled. So basically your piece, your share has halved in value. And that's at the same time as a business like Flight Centre is shrinking over time, is losing, is becoming less profitable and producing less revenue. So it's kind of like going from having 1/8 of a pizza to having 1/16 of an even smaller pizza. Businesses that can remain profitable during a short-term event have a very, very low risk of going bankrupt like a Virgin Australia. Assuming that they don't have huge amounts of debt that is due in the period where the short-term event is happening, then if the business remains profitable, it really doesn't matter how long the short-term event goes for, the business will be okay. And when the short-term event goes away, they will return to having much larger amounts of profits coming out of the business. And then the final reason why you may want to avoid some travel businesses in 2021 is that some of them are just still too expensive, right? So whenever a short-term problem happens in an industry and impacts certain businesses specifically, then typically speaking, the stock prices of those businesses will go down. But sometimes the stock prices don't go down at all if it's a really, really well-known business and people are still very confident in the business long term. And in other cases, the stock's price will come down, but it just won't come down further enough for it to be a viable long-term investment. What you should do, instead of focusing on how much the stock has fallen from the peak to where it is now, you should focus on what the current price is, regardless of how much it's fallen or gone up, and comparing that price to an estimate of the future cash flows of that business. For example, let's say we have a stock and we estimate that over the next 10 years, we expect to get back about $150 per share from that investment. That's what's going to be delivered to us in the form of dividends, share repurchases, and the stock price going up over time. If that stock has a stock price that falls from $200 to $150, it doesn't matter that it has fallen a significant amount, 25% in that case. It is still too expensive for us to make a good investment and to have a good relationship between the price we're paying, the money we're outlaying, and the money that we get back. If that same business was expecting to deliver us $150 per share, I don't care what the stock price was originally. All I care about is what the price is when I'm buying it. And if it's delivering me $150, then I'm probably not willing to pay more than about $50 per share for that stock. I think a really good example of this, at least for me, is what happened with Booking Holdings, which is an online travel agency. I think it's maybe the biggest in the world. And its stock fell 43% in March during the height of the pandemic. But for me, that still wasn't enough for it to get cheap enough to be a good investment. It was basically going from being outrageously expensive, in my opinion, to becoming a little less expensive or maybe closer to fair value, but certainly not undervalued. So I guess the last lesson here is that just because the travel industry overall is suffering, that's not enough for you to just want to buy into any travel stock and assume that it's going to do well over time. The business has to have really good characteristics, some of those that we spoke about in today's video, and you need to be able to purchase it at an appropriate price. So I hope you guys enjoyed today's video and got some value out of it. And as I mentioned halfway through the video, you can download my free stock analysis spreadsheet. It will help you do some of the debt ratio calculations and all of the other calculations that I use at the core of my analysis when I'm trying to analyze a business and figure out whether it's a good business and then whether it's a good investment. A link to download the free spreadsheet is in the description below. And there's also a link to a video that gives you a full rundown of basically a full guide of how to go through and enter in all of the data within a couple of minutes so that you can quickly apply and start looking at the core important numbers for any business, whether it's in the travel industry or some other industry that you're looking at. If you want to see more content like this and you're not subscribed, then the best thing you can do is go down below, hit that red subscription button, and then hit the notification bell next to it so you get notified when I am posting. And of course, let me know your thoughts down in the comment section below and leave a like, of course, if you can. It only takes you a couple of minutes and it helps me out so much you would not know. But other than that, I hope you guys have a great day and I'll see you in the next video.